Named as one of the 4 investment giants of the 20th century by Fortune magazine, John Bogle shook Wall Street to its core by creating the world's first index fund. Here are some of the best John Bogle lessons that help you navigate the financial jungle and avoid some of the most dangerous traps that people fall into. If you're not aware of these traps, the financial industry will literally drain your savings faster than your boss drains your patience. I thought there was such a thing as a permanently good investment manager. There is not. They come and go. Bogle strongly believed that most fund managers who get dazzling returns are lucky, not skilled. In fact, 95% of the reason is luck and 5% is skill. To illustrate, he uses this analogy. You can put 1,000 people, or gorillas if you want to make it interesting, in a room and tell them to flip coins. One of them will flip heads 10 times in a row and you would call him a lucky guy. But in the fund business, people would call him a genius. If your fund manager somehow beat the market and got a better return last year, it was most likely luck, so don't expect that every year. Most individual investors pay too much for the privilege of being average. Investment titans like Bogle and Warren Buffett have often said that most actively managed funds will not beat the market, for example, the S&P 500 index. And since active management is more expensive than passive management, you're overpaying for a crappy product. Bogle estimated approximately 2% per year in fees for the average fund. Expense ratios, transaction costs, cash drag, sales charge, and so on. If the fund grows 7% per year, you will only get 5% per year after fees. That 2% a year doesn't sound like a lot, but you're losing approximately 70% of your money to it. How? Let's say you invest $1 and you let it grow for 50 years. If you don't pay any fees and get 7% a year, your $1 becomes $33 after 50 years. But if you pay a 2% yearly fee and instead grow at a 5% per year rate, your $33 becomes approximately $12. You put up 100% of the money, took 100% of the risk, and got 30% of the rewards. As Donald Trump would say,
is the worst trade deal maybe ever signed anywhere.
If you're enjoying this video so far and finding it valuable, make sure to hit that like and subscribe button down below for more videos like this. They don't understand we have this conflict of fiduciary duties. The manager of a publicly held firm like, say, BlackRock has 2 sets of fiduciary duties. One is fiduciary duty to the shareholders of BlackRock mutual funds to maximize their returns. And the other is the fiduciary duty to earn the most money they possibly can for the public owners of BlackRock. People often forget that the mutual fund companies do not work only for you. They work for both the shareholders of the firm, for example BlackRock, and the shareholders of the mutual funds, like you. So there's a conflict of interests. To benefit you the most, the firm has to lower fees. But to benefit the firm the most, the firm has to raise fees. More times than not, the firm's profit is prioritized over yours. Otherwise, you be rich and they be out of business. Now that you know what traps to avoid, you have to know what to do. Diversify through low-cost index funds. And don't trade. Don't do something, just stand there, no matter what. And you'll be able to resist that temptation to sell more easily if you had a little bit more of your assets allocated to bonds than you think you should. Bogle suggests buying and holding low-cost index funds. An index fund is basically a portfolio of stocks or bonds that tries to mimic the returns of the overall market for a very cheap price, around 0.03%. For example, the Vanguard 500 index fund tries to mimic the performance of the S&P 500 index, which is made up of the 500 largest US companies. If big market dips scare you, put more in bonds than stocks. You will make less money in the long term, but this will help you avoid panic selling. Investing is an emotional game. If you want to be successful, you must fight off your urge to sell when the market crashes. Also, don't waste time trading in and out of the market and trying to find the best times to enter or exit. Instead, get a portfolio that will soften the drops and give you almost stock-like returns. If you need a recommendation, billionaire investor Ray Dalio has your back. He calls it the all-season portfolio, intended to do well in all of the economic seasons. This next video will pull back the curtains to show you exactly what's inside.